Just the last thing, I've done why I don't use stop losses. I've done why I don't trade with charts. And I just want to talk about something else that I see on, if you're a YouTube, trying to learn from YouTube trading, they're all, they're one product or two product, maybe three product traders. The short-term guys are like one underlying at any one time. Some people have, no, that's it. You just see they're basically all in on one product for a short amount of time. And I'm the opposite. I don't know, I don't even know how many underlyings, around 300. And I'm not saying you need to, I'm a bit extreme, but at least, well, I like to have as many underlyings as possible. Anything that's liquid, in the news, volatile, I want a position. And then it enables me to generate free cash flow. And my struggle with, I've done the whole one product thing. I've traded cable for months on end, just cable. And it's a really tough gig. If you're, I see FX gurus on YouTube, and it's all or nothing. And my point is, the professionals have portfolios. That's a bit of a term, isn't it? Professionals have portfolios. Maybe that should be the title. And non-professionals play the lottery. So just when you're following your next YouTube guru and he's only got one position on in one underlying, my point is, there is another way. I'm not saying they're wrong. I'm not saying stop losses are wrong. I'm not saying charts are wrong. And I'm not saying trading one product is wrong. Loads of people out there that do all three things really well. I'm just saying there's another way. And I don't think people sell portfolios of many positions because it's not sexy. It's small wins, not big wins. And again, I've spoken about small wins before. I'm the Mackie D's of trading. I'm taking out such small amounts, but on a really frequent basis, like Mackie D's. If someone said, set up a store and you'll make 20 cents every burger you sell, you're going to be like, what? Why would I do that? And I get it, but how big is Mackie D's? How big is Starbucks? Biggest companies in the world, and they make a few cents every transaction. And that's my methodology. Again, I'm just trying to highlight other ways of doing things, because the YouTube traders I see are all in on one position, on one trend line, or some trend line break, or some like all this nonsense they talk now, this ICT and these, what are they called, the tiny little bars that they say, order blocks. I mean, I've never read such nonsense as I have order blocks. Whereas if you walk into any professional outfit I've been in, they all have not vast portfolios, but they'll have a list, 20, 30, 40 positions, 50 positions, maybe 60 positions. I'm a little extreme. And for me, it's that Starbucks model. It's that Mackie D's model. Clipping off a little bit at a time. Much easier to do than these big hit YouTubers. That, they're trying to sell something, so they need it to look good. And there's much less pressure if you're just clipping off $5, $10, $100. I'm making up small numbers here. I don't know, $1,000. And every now and again, you log into the portfolio and something's gone up 30%. Something's sometimes gone down 30%, but sometimes it's gone up 30%. Then it's a big number, and that's great. Take those all day long. But I'll also take 30 times $200 in a day, no problem either. That is my bread and butter. So just give me another way to do it, that's all. Make a lot of trading videos, and the main thing I'm trying to get across is that there's another way, because I find the YouTube trading content is all very similar. It's all charts, 3-to-1, FX, sometimes crypto. Actually, no, there's not actually that many crypto trading videos. Anyway, so it's just that there's another way. And a lot of people are using technicals, a lot of charting, a lot of lines, a lot of indicators. And I'm sure some guys make it work for them, but just have a think. Or this is the conclusion I got to. Because don't worry, I tried trading off charts too, and technicals and lines, and I mean, I spent time with Elliott wave, I spent time harmonic patterns, I spent time with all the indicators, seeing if you know this one and that one, combine it in with this and that, and you then buy when all three are aligned and all this kind of stuff. And as you can tell, that was all historical, because I don't want to say it didn't work. It didn't, there's no edge in that. And there's a reason why there's no edge. And I think just understanding this is really crucial. I'll try and explain it as best I can. If, and it happens, someone writes a new indicator, and that strategy works. So, I don't know, back in the day, maybe moving average crossovers, the most simplest of simple. When they crossed over, people bought, right? And they made money, let's say, just imagine. And then it becomes known that that is working. Well, by the very nature that that works, will stop it from working. Because people will, they'll pre-jump. They'll change from a 20 over a 5 to an 8 over a 4 to until it's gone, until that edge is gone. And I've spoken about edges coming and going before, and this is why. So people think about when a market is like wave patterning up, and then people draw a line right along all the touches, and then they try and buy the next touch. Well, by the time you've got two touches to create your line, and you buy the next touch, is there any person on the planet that isn't also preempting that trade? So by its very definition, it will fail, because there's no edge there. And this is why I said before, don't look at the support line, or, you know, I hate the word support and resistance. I prefer buyers and sellers, because it gives you the wrong, it's the wrong mindset when you talk about, there's no actual resistance, there's buyers. Anyway, so if you deem there are buyers at a round number or something, or there's some key level, and you feel like there is support, done it, see, just fell for my own narrative. Maybe support for the price. The easiest way to trade is not by trying to buy that support, that area of buyers. It's to hope that it fails and sell the break. That is the better way if you want to have charts, lines, indicators, because you want the most pain. You want the traders, you want people in positions who own the stock or the whatever it is. So the way to picture this is, I picture it like you've got a boat, you know, one of those boats you go on a tour, like 40 people, right? And in normal circumstances, I don't know what these bugs are, they're pretty rowdy. The boat's full, right? 30 seats, 30 people, and you've got people jumping on and off. So the price is just moving, because let's say there's more aggressive sellers than buyers. So the price is coming down. Now, there'll be let's say there's loads of people drawn on a resistance line, and there's a moving average, like there's a 50 moving day average and a fib and all this confluence, and all the YouTubers are going mad. So at 400, let's pick a price, all these people jump on the boat. Okay, and they sit there and they wait. They're like, oh, you know, this is support. Yeah, we should go back up now. Well, you then need more aggressive buyers than sellers to make the price go back up at this turning point. And let's say it bounces a little bit. You've got all these people on the boat. They can't quite take profit yet. And there's not enough aggression in the buying to make the price go up. So it drifts back down. And eventually, all those people on the boat have to bail. All the ones that jumped on have to bail. And they have to bail quickly. So as it hits their point where they're proved wrong, they have to hit the sell. And that's when all the others on the boat that were already short are happy also to double up now their position because of the break in what was perceived strength at that point. And then you get this cascading down move. That's much stronger than thinking something's going to change direction and go up. I hope that's like semi-made sense. So it's always not what's going to happen, but I much prefer the position of how do we trap as many people as possible. And it's these lovely key levels that people will buy at, and then it's rug pulling them, and then it drops down the next level. Because if we could all just buy at support or sell at resistance, we'd all be trillionaires. Just think about it. We'd all be trillionaires. It would all be so easy. If you could just buy at the 200-day moving average, wouldn't it all be so easy? Why would anyone chart ever again? Why would we still be here 30 years later? It was all that easy. And it's just edges. As soon as an edge is found, a technical edge, it has a limited lifespan. Because computers are searching out for these edges, and eventually they stop working once enough people have tried that edge. All right, that's it.